I think just the tenant experience angle is more important than ever. I think for those companies that are relocating, they're creating a new work environment. They want to be sensitive to all levels of their employees, where maybe historically they might have been a little bit more skewed towards senior level employees now from top to bottom. And creating an environment that's better than the environment that maybe people had pre COVID. So whether they're going to renew in place and do some improvements or they're going to relocate, what can we provide to make their life simple, easy, and efficient?
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. Today we're looking at the US office sector, specifically potential changes that conversions and demolitions could have on office supply. To learn more, I'm speaking with Mike Watts, CBRE's President of Investor Leasing in the Americas. So, Mike, thanks for joining the podcast today.
Thanks for having me.
So let's jump right in and talk about what the CBRE data shows regarding the pace of office conversions and demolitions in the US versus new construction.
Sure. This is a pretty unique time in that this is the first time in quite a while that the amount of demolition and conversion is exceeding the amount of new construction delivered. Part of that, obviously, is the demolition conversion component, but the bigger side of it is actually the lack of new construction we anticipate for 2025. Right now, we expect the number of new office deliveries to be about 25% of what they were in 2019. So it's really the fact that we're just not going to see a lot of new construction being delivered in the near future for office. And there are a number of reasons why that is.
And how do you see those trends playing out in the next few years?
Well, I think a couple things are likely going to happen. When you have a lack of new construction, which is considered the top quality space, the prime quality space, what happens for users that focus on that segment of the office population is they've got to figure out an alternative. Oftentimes, if they can't find what they want at that new construction level, they're going to drop down to an existing building that is of trophy caliber in the market that they're looking at. If they can't find that, they might drop down to a really nice Class A building that's well located, great access, good amenity package. So the ripple effect is that that demand has to go someplace, and there'll be other buildings that benefit from there not being a large supply of new construction entering these markets.
Let's talk a bit about conversions. What are you seeing as the most common types of conversions underway in terms of new property type and market location?
The most common type you're going to see is multifamily by far. The traditional steel and glass office building doesn't lend itself to a lot of conversion opportunities that aren't very expensive. And converting to multifamily is very expensive also, but it can be done. And the other thing, when you look at a multifamily conversion of an office building, actually some of the older architecturally significant buildings, maybe 100-year-old Art Deco building, actually can be quite attractive from a conversion standpoint for those people you would be trying to attract as renters. They like the architecture, maybe the floor plate that isn't a conventionally efficient office floor plate actually works well with some of the nooks and crannies that somebody would accept in an apartment. So it's a little counterintuitive, but sometimes some of the older buildings actually are easier to convert than the newer buildings. And newer, I mean, 30, 40, 50-year-old buildings, but it is a very expensive proposition to do it. That's why the amount is still relatively small.
And what about market location? Are certain cities just much more popular for that type of activity?
I think it's less about the city and it's more about the fact that the downtown, the CBDs in many markets, whether it's New York City or whether it's Chicago or whether it's Cleveland, you can make an argument are underserved for quality apartments. And given that, you have a natural pent up demand, and the conversion could actually meet some of the demand that's already there. So if you could execute the conversion financially so it makes sense, you're often going into a market that can accept it from a demand standpoint.
Great. And what are you seeing in terms of the balance between conversions versus demolition? Are there certain factors that are helping those decisions?
Sure. I think the number one factor is when you look at an existing building on an existing site, is it the highest and best use for that site? So if you're in a market and you have a main location, but the building on it is functionally obsolete, say from an office standpoint, and or the building is too small relative to the site and you could really do something far more significant on the site, maybe do something mixed use that has some office, some multifamily, some retail, some parking. Those are the kind of things that people take a look at. Is the building as it stands, is it the highest and best use? And then the other thing that they take a look at when you're looking at demolition is if I want to convert the building because I believe there is a path financially forward to do that, is the cost of doing something on a conversion basis, how does that compare to tearing something down and starting from a blank slate? Many instances, you can make an argument it's less expensive to tear the building down and start again than try to retrofit an existing structure with old mechanical systems, old elevators, maybe the fenestration of the building, the curtain wall doesn't lend itself well. And in a perfect world, you would do something different. It may just make sense to demolish the building and start from scratch.
Do you think the current situation with labor supply and construction costs is that coming into the decision making?
Construction costs are front and center. And that's one of the reasons why you don't see a lot of new office construction, both starting and some of the deliveries not happening or slowing down radically. And that's why we have that lower number and that imbalance for the first time that we talked about. It is so expensive to construct an office building. There may or may not be some impacts of tariffs. The cost of a tenant moving into an office building, the cost of them building out space, if say they're a high-end professional services firms, can be $300 to $400 per square foot to build the space, furnish the space, and wire the space with audiovisual. And so when you look at that tremendous amount of costs, it's very difficult for a developer to get a loan sufficient to make the financial sense to build a brand new office building. So that's why, we see a governor on supply for 2025, and that governor we think is going to extend into 2026 and likely will not see a higher level of delivery of office in 2026 either.
And we hear a lot about the demand for highly amenitized office space, but isn't there still healthy demand for really more affordable office space?
I would say rumors of the Class B office building being gone are seriously overdrawn. There are certain office tenants, because of the kind of use of the space or the image of their particular business or industry, that do not find value in moving into high end buildings. The image might be inconsistent with what their business model is, or like all of us, there are plenty of us who could drive a luxury car if we wanted to pay for it, but we don't find the associated value. We rather would have a good, solid car that gets from point A to point B. And that's where the Class B market comes into play. So there will always be plenty of demand for Class B space because there's some tenants that don't find value in Class A trophy or new construction.
Talking about the Class A again, with all these great amenities, how many more new amenities can be offered? Does it come to a point where you've sort of done everything that you can to trick out the space and there's nothing left?
Yeah, I would say right now, when I straw poll our brokers across the country, there are so many different types of amenities, depending on what market you're in, that we've kind of reached the point where you do need to have a good amenity package at your building. Depending on the size of your building and scale of your building, your baseline would be a fitness center, a conference center, and a tenant lounge. In some combination, size wise, of those things, outdoor space if you have it. But the F1 simulators, golf simulators, pickleball, those kind of things you still see added in instances, but most tenants will tell you right now, give me a good solid amenity package. Of the amenities that seem to be increasingly important in the last 4 years is conferencing. So a conference center that from a capacity standpoint may be a little bit bigger than what used to be designed. So let's say seats 150 people, training room style. That's where things are trending, 150 and above. That's become, much more important as many tenants may have situations where they want to get everybody in the office in one place, town hall style. Their existing office can't do it. And the cost of going off site, which typically would mean you're going to a hotel, that has gotten very, very expensive. That's why you see movie theaters often advertising, why don't you do your corporate meetings, large meetings in a movie theater, since they don't have a lot of demand on a weekday in the morning. So the conference center is probably the amenity that's getting the most scrutiny right now, but a fitness center and a tenant lounge also round out the amenity package. But to answer your question directly, I think right now, everything that needs to be done from an amenity offering has already been done. So it's just making sure you pick the right things and you do them, but you don't need to innovate anymore.
And Mike, what are some other trends or developments that you're seeing in the office leasing sector today that you find interesting?
I think just the tenant experience angle is more important than ever. I think for those companies that are relocating, they're creating a new work environment. They want to be sensitive to all levels of their employees, where maybe historically they might have been a little bit more skewed towards senior level employees, now from top to bottom, and creating an environment that's better than the environment that maybe people had pre COVID. So whether they're going to renew in place and do some improvements or they're going to relocate, what can we provide to make their life simple, easy, and efficient? The other thing that's very important, if you can do it, is I think there's a heightened focus with these tenants on how does the building meet the street? And what I mean by that is, hey, what's my neighborhood on the ground floor? Do I have some retail, some food, beverage? Can I grab a sandwich? Can I grab a salad? Can I grab soup at lunchtime? So I can just drop down, stay efficient, head right back up to my office, eat lunch at my workspace and keep going? Or do I have to travel a long way? Are the amenities not aligned with the kind of employees that I have? Meaning perhaps there's a lot of white tablecloth restaurants in my neighborhood, but that's not my employee base. They need grab and go. So I think food and beverage and the overall tenant experience become tantamount to these tenants as they decide what buildings they're going to renew in and what buildings they're going to move to.
And Mike, just to wrap it all up, how would you describe overall sentiment in office leasing today?
I would say that when I straw poll our brokers across the country, they're cautiously optimistic about leasing activity. I think you've seen more buildings trade in the last 6 months. So we expect to see more of that. Some people are taking advantage of some depressed valuations. Other people are finding opportunities in good, solid real estate, in good, solid markets, in main locations where maybe historically they wouldn't have an opportunity to buy into that kind of product with those characteristics. And now they do. So they're taking advantage of it.
Mike, thanks so much for your time today.
Thanks. Great to be here.
And if you enjoyed this episode of the REIT Report, please subscribe or leave a review on your favorite podcast platform.